A multifamily commercial property is any property with 5 or more residential units and usually is more profitable investment than a single family rental. Here are some steps if multifamily property is right for your investment needs. Before getting started, it's important to know what you'll be able to afford, how much debt you can take in relation to your equity, and how much profit are you looking to realistically make. The very first step in investing in a multifamily property is to conduct market research. It's important to have an idea of how the housing market is doing at any given time so you can make an informed decision and know what you're getting into. Have your realtor connect you to a local appraiser to get a better understanding of the asset in question. They know what makes a property worthwhile and what detracts an investment property from performing to its commercial appraisals. The next step when investing in a multifamily home is to figure out the location. To do so, an investor has to know what their goals are and how a certain neighborhood can help them achieve those goals. Some factors to consider when researching neighborhoods are school districts, nearby attractions, public transportation, parking, amenities nearby, businesses, conditions and price of the homes in the area, neighborhoods and landscaping, appearance, safety, the housing market in the area, zoning bylaws, future building projects in the neighborhood. Each of these factors will affect the price and the value of the real estate investment over time. While you can make the changes to the property itself, you can't make any changes to the location. Therefore, it's very important to have a thorough understanding of the neighborhood before investing in a multifamily property. Securing financing is an essential step in purchasing a multifamily property. When looking at real estate, you want to make sure you can actually afford to make a purchase. Often investors might find their dream property only to realize they cannot afford it. Therefore, it's important to know how much you can spend before you set your hopes on any property. Usually, you'll need a long-term loan in order to finance your investment. You want to be sure to do some research on loan rates, terms and conditions, loan to value to figure out what you can afford. Banks usually can help you with a pre-approval letter before you find your property to ensure that you will be able to secure the loan when the time comes. Is the multifamily property you are interested in ready to go, or will you need to conduct significant repairs before renting out the space? How much will those repairs and renovations cost, and how long will they take? Is the overall investment worth the money, time, and the work involved? When determining whether or not to purchase a multifamily property, you also want to calculate your future expenses. Property taxes, foundational, structural, mechanical, plumbing, HVAC heating are important expenses to consider. If you've estimated long-term expenses outweigh the profits, then it's probably best to keep looking for other properties. NOI assesses the initial value of the property and determines the property's ability to generate income. To calculate the net operating income for a property, you will need to subtract the property expenses from the total revenue or income that the property generates in 1 year. Operating expenses include the cost of maintaining and running the property, management fees, utilities, insurances, property taxes, and repairs. Total revenue includes everything that comes in, such as rent, parking, fees, vending machines, etc. Before putting your money into a property, it's essential to know your cash flow. To understand the cash flow, you will need to know your interest payments to the lender, your gross rents, cost of operation, maintenance, utilities, property taxes, insurance. Total cash flow can be calculated by subtracting your mortgage payments and reserve for future capital expenses from the NOI. The cap rate on the property is calculated by dividing the property's estimated net operating income by the current market value. You can estimate the market value by using property's listing price. Essentially, cap rate evaluates the expected rate of return on the property. This formula allows the investor to understand the profit. Low cap rates are an indication of low listing prices, and higher cap rates are for more profitable properties. Always complete the property's due diligence when doing research on multifamily investments. Check for risks, violations, potential lawsuits, unpaid penalties, and many more. Make sure you have copies of bank statements, rent histories, unit inspections, and other documents that will verify the numbers and facts of the property. It's also important to inspect the building and see the property yourself. Check for any structural damages that could lead to problems down the line. You should consult a professional like a broker, a lawyer, a tax expert for advice before making your decision. Once you've completed all the steps and have decided to purchase a property, it's time to negotiate a purchase price based on the current NOI and cap rate. Once you've calculated the purchase price, you can make an offer. Don't let the asking price deter you if your purchasing price calculation is lower. And don't overpay for the property that isn't worth it. Make sure you do your research before investing in a multifamily property, ensuring a steady stream of income for years to come. If you are in the market for any kind of real estate investment, and if you found this valuable, please feel free to subscribe to my channel. My name is Sunny Duggal, 647-628-4326, and I'm with EXP Realty. Thank you.